Hey everyone! Welcome back to the channel. Today we're tackling a topic that's often surrounded by mystery and curiosity: how the wealthy manage to pay so little in taxes. You've probably heard stories about billionaires and corporations paying a fraction of what regular people pay in taxes. And maybe you've wondered, how is that even possible? In this video, we're going to break down the strategies the wealthy use to legally reduce their tax bills. From smart investments to complex trusts and clever estate planning, these methods aren't just about loopholes, they're about leveraging the tax code in ways that anyone could potentially use with the right knowledge. We'll look at everything from capital gains to charitable giving and more to understand how these strategies work and why they're so effective. So, if you're curious about how the rich navigate taxes, or maybe you're looking for ways to make better financial decisions yourself, stick around. By the end of this video, you'll have a clear picture of the tools and tactics that could help you think about your own financial strategy in a new way. Let's get started. All right, let's start by talking about one of the most popular strategies the wealthy use to minimize their tax burden: tax-advantaged investments. These are investments that come with special tax benefits, allowing you to grow wealth while keeping more of your earnings in your pocket. Here's how they work and why they're so effective. First, let's look at capital gains and dividends. Unlike regular income, which can be taxed at a high rate, long-term capital gains, the profit from selling an asset held for over a year, are typically taxed at a lower rate. This is why wealthy investors often prefer to invest in assets like stocks, real estate, or even businesses. When they eventually sell these assets, they pay a lower tax rate on the profits. By holding on to investments for at least a year, they can take advantage of the long-term capital gains rate and significantly reduce their tax bill compared to ordinary income. Another key tool is municipal bonds. These bonds are issued by local governments to fund projects like infrastructure, schools, or public services. The interest earned from municipal bonds is generally exempt from federal income taxes and, in many cases, state taxes as well. For high-income earners, this tax-free income can be incredibly valuable. Municipal bonds don't usually offer high returns, but the tax savings can make them a strong choice for those looking to balance their portfolio and protect their income from taxes. Next, we have retirement accounts such as 401(k)s, traditional IRAs, and Roth IRAs, which offer substantial tax advantages. Contributions to 401(k)s and traditional IRAs are typically tax-deductible, meaning they reduce taxable income in the current year. The investments within these accounts then grow tax-deferred, meaning the investor doesn't pay taxes on gains until they withdraw funds, often in retirement when their income and tax rate might be lower. Roth IRAs work a bit differently. Contributions are made with after-tax dollars, but the funds grow tax-free, and qualified withdrawals are tax-free in retirement. Wealthy individuals maximize these accounts each year, using them as both a tax shelter and a means to build a long-term financial cushion. For high-net-worth individuals, health savings accounts can also serve as tax-advantaged investment vehicles. HSAs allow for tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Some wealthy investors treat HSAs as an additional retirement account, investing the funds and allowing them to grow over time while paying for current medical expenses out of pocket. By doing this, they can maximize the investment potential of the HSA and take advantage of its triple tax benefit. Another powerful strategy involves real estate investments. Real estate offers several tax advantages, from depreciation deductions to tax-deferred exchanges. Depreciation allows property owners to deduct the cost of wear and tear on the property over time, which can offset rental income. Additionally, with a 1031 exchange, real estate investors can defer paying capital gains taxes on a property by reinvesting the proceeds into a similar property. This allows them to grow their real estate portfolio without taking an immediate tax hit. Lastly, many wealthy individuals invest through private equity funds and venture capital. While these require high initial investments, they offer significant tax benefits, such as carried interest, which is a share of the profits that's taxed at the lower capital gains rate rather than ordinary income rates. This tax treatment can make a big difference in reducing tax liabilities for those in high-income brackets. In summary, tax-advantaged investments are all about understanding and leveraging different parts of the tax code. By focusing on investments that offer lower tax rates or allow tax deferral, the wealthy can keep more of their earnings, grow their wealth efficiently, and minimize their taxable income. And the best part? Many of these strategies are available to anyone willing to take a strategic approach to their investments and make the most of the tax benefits the system offers. Another powerful strategy that wealthy individuals use to manage their tax burden is charitable giving. But it's not just about generosity, it's also a smart financial move that can reduce taxable income, support important causes, and leave a lasting impact. Let's dive into how the wealthy maximize the tax advantages of charitable donations. One of the most straightforward methods is through direct donations to qualified charities. When someone donates cash or assets to a recognized nonprofit, they can generally claim a tax deduction for the full value of the donation, which reduces their taxable income. For high-income earners, this can significantly decrease their tax liability while supporting causes they care about. Importantly, donations don't just have to be cash. They can include appreciated assets like stocks, real estate, or even artwork. Donating appreciated assets offers an added advantage because the donor avoids paying capital gains taxes on the appreciation, allowing them to contribute a larger amount while getting a full tax deduction. Another popular tool is the donor-advised fund. This is like a personal charitable savings account. The donor contributes funds, receives an immediate tax deduction, and can then recommend grants to charities over time. DAFs allow individuals to make a large donation in a high-income year to maximize tax savings, while still having flexibility to support charities over multiple years. This setup is appealing because it allows donors to make a long-term charitable plan without rushing into specific decisions about where to donate immediately. For those looking to make a substantial impact, private foundations offer even more control. A private foundation allows the donor to establish a charitable entity in their own name and fund it with their contributions. While foundations have specific legal and operational requirements, they offer a powerful level of influence over how funds are distributed. Donations to a private foundation provide an immediate tax deduction, and the foundation can distribute funds to charities over time. Many high-net-worth individuals use private foundations not only to reduce taxes, but also to create a family legacy involving future generations in philanthropic work. Wealthy individuals also use charitable remainder trusts and charitable lead trusts as more advanced giving strategies. These trusts allow donors to support charities while retaining certain financial benefits. For example, with a CRT, an individual donates assets to a trust and receives income from the trust for a set period. At the end of that period, the remaining assets go to the charity. This setup offers an immediate tax deduction based on the projected value of the assets that will go to charity, while the donor continues to receive income. With a CLT, the charity receives income from the trust for a specified period, after which the remaining assets return to the donor's beneficiaries. This is especially useful for estate planning, as it allows individuals to pass assets to heirs at a reduced tax rate. Some wealthy individuals also contribute through qualified charitable distributions, QCDs, from their retirement accounts, particularly if they are over the age of 70 and a half, and are required to take required minimum distributions, RMDs. By directing RMDs to a qualified charity, they can exclude the amount from taxable income, effectively using pre-tax dollars to support causes they care about. This is a smart move for retirees who are charitably inclined and looking to manage their tax burden in retirement. These charitable strategies go beyond tax savings. They allow individuals to make a meaningful impact on the causes they care about while also benefiting financially. In many cases, charitable donations become part of a broader financial and estate plan, with family members and future generations involved in the philanthropic process. This not only helps build a lasting legacy, but also reinforces a culture of giving within families. In summary, charitable donations provide an excellent way to reduce taxes while contributing to meaningful causes. Through direct giving, donor-advised funds, private foundations, and charitable trusts, wealthy individuals can strategically manage their tax liabilities while supporting the organizations and issues that matter most to them. By taking advantage of these giving vehicles, they create both a positive social impact and a smart financial strategy that helps preserve their wealth for the future. A key strategy that wealthy individuals use to navigate and optimize their tax obligations is hiring skilled tax professionals. Taxes are complex, and as income and asset levels grow, so does the intricacy of financial management. High-net-worth individuals typically rely on a team of tax advisors, accountants, and financial planners who specialize in wealth management to help them make the most of the tax code, stay compliant, and maximize their tax savings. Skilled tax professionals do more than just file taxes. They create a personalized strategy for their clients. For instance, they assess income streams, investment portfolios, and planned expenses to recommend tax-efficient ways to allocate resources. This can involve anything from structuring investments for optimal capital gains rates to suggesting tax-advantaged accounts like IRAs, 401(k)s, or health savings accounts, HSAs, to lower taxable income. These professionals also look at short and long-term financial goals, creating a plan that considers future tax implications. For example, tax advisors often help clients decide when to sell certain assets to either minimize capital gains, tax, or take advantage of tax loss harvesting opportunities. The tax code is filled with lesser-known deductions, credits, and loopholes that can benefit taxpayers if they know how to use them correctly. Skilled tax professionals know these inside out and can help clients take advantage of them legally and effectively. For example, they might identify opportunities in renewable energy credits, small business deductions, or deductions for certain medical expenses. They are also skilled in strategies like income shifting, which involves legally transferring income from high-tax to low-tax entities or individuals, such as through family-limited partnerships or trusts. These strategies are complex and require professional expertise to ensure they're implemented properly and legally. Another powerful set of tools the wealthy use to manage taxes involves income deferral and carry-forward strategies. These approaches allow high-net-worth individuals to delay or spread out tax liabilities, ensuring they only pay taxes when it's most advantageous. By strategically timing income, losses, and deductions, they're able to reduce their immediate tax burden and often secure significant savings over time. Let's look at some of the key deferral and carry-forward strategies that can make a big difference. For high-income earners, deferred compensation plans are one of the most popular deferral tools. In these plans, executives or business owners agree to receive a portion of their salary or bonuses at a later date, such as retirement, rather than when they earn it. By deferring compensation, they reduce their taxable income in the current year, which can lower their tax bracket and overall tax rate. This is particularly advantageous if they expect to be in a lower tax bracket when they eventually receive the deferred income. Examples of deferred compensation include non-qualified deferred compensation, NQDC plans, and 401(k) plans. While NQDC plans don't offer the same protections as qualified plans, they give more flexibility in contribution amounts and payment schedules, allowing individuals to tailor their income to fit future tax goals. In conclusion, while paying taxes is something everyone faces, the wealthy use specific, legal strategies to minimize their tax bills. By leveraging tax-advantaged investments, charitable contributions, income deferral, and expert tax planning, they're able to protect and grow their wealth efficiently. These strategies aren't just reserved for the super rich. Many are available to anyone willing to learn and apply them with the right guidance. If you're interested in building a tax-smart approach to your finances, consider speaking with a tax professional to explore what's possible. Thanks for watching, and don't forget to like, subscribe, and stay tuned for more insights on managing wealth and financial success. See you in the next video.